Hey, ambitious dentist, welcome to Start Your Dental Practice, the show for existing and aspiring dentists to take your dental practice to the highest possible level. I'm your host, Jonathan Van Horn, CPA and ABV, founder of dentistmetrics.com. In every episode, we aim to demystify the how to start a dental practice problem by bringing on world-class dentists, influencers, and consultants in the dental industry to pick their brain about how to get past the barriers involved from going from no practice to being a practice owner to owning your own successful dental practice.
So the chances are, if you're listening to this podcast, you've got some student loan debt. Now, having worked exclusively with dentists for most of my professional career, it's not common for me to see aspiring practice owners coming out of school with $400,000 to $500,000 in student loan debt, and that's only for the dental license. While we can debate whether or not the large costs are justified, the reality is, without a student loan plan of attack, you're going to be stuck making payments for the rest of your life, which is why I'm really excited to share my conversation with Travis Hornsby, founder of StudentLoanPlanner.com. So Travis has helped hundreds of professionals take control of their finances and student loan debt. He also has an incredible track record of helping his clients become debt-free. So even if you're fortunate enough to have paid off your student loans, I know you'll find a lot of actionable insight from our conversation. So here's a few things you're going to learn. How Travis got into helping others with their student loan debt. It involves his significant other. How being featured in Business Insider skyrocketed his career. What he's learned from advising over $82 million in student loan debt collectively amongst his clients. Practical ways anyone can save money to help pay off their student loans faster, why tracking your student loan can have a huge impact on getting results, as well as a whole lot more. So at the end of the episode, you're going to learn how to get Travis's incredibly useful debt calculator. So be sure to listen to the end to find out how to get access to that. Now here's my interview with Travis Hornsby. Hey guys, sorry for the interruption. Really quick announcement for you. And if you're going to be a dental practice owner, you know you're at some point going to have to get a dental practice loan, whether it's going to be to acquire a dental practice or it's going to be to start a startup dental practice. You're going to have to get a loan. And I'm really proud to say that a company that I've worked with personally dozens of times over the past few years is our first sponsor after 80 episodes of Start Your Dental Practice. And our first sponsor is Bank of America Practice Solutions. So whenever you're going to be getting a new loan, whenever you're going to get a loan for starting your dental practice or acquiring a dental practice, you really want to make sure that you have three things when it comes to that loan. Number one, you want a really great interest rate. Number two, you want to make sure that the company that you're speaking with has a lot of experience and can guide you through the best path to be able to become a practice owner through the loan process. And number three, you want to make sure that the terms associated with that loan are the most advantageous for you. And I'm really happy to say that all three of these things, Bank of America just knocks it out of the park for you. And they've got some really great new promotions that I'm not even sure if one of these that they've even announced anywhere else other than what I'm about to say to you on the Start Your Dental Practice podcast. So, SYDPers, here is the announcement for this. So, number one, interest rates. They've got a couple of really great promotions. The first one is on new acquisitions. The first year of that loan, 1.89% for a dental practice acquisition right now in the first year. That's crazy low. You never even hear of loans dipping below 3%. Nonetheless, less than 2% on that first year. And then after the first year, it's still super competitive compared to everybody else out there because Bank of America always comes in as either the lowest interest rate or one of the lowest interest rates of any banks that are out there. So that's the first part of that. Again, you want to make sure you have a great interest rate. Number two, you want to make sure that the company you're working with has a lot of dental practice experience. I don't know if any company out there in the world has more dental practice loan financing experience than Bank of America does. They're fantastic at it. Their reps are really good, and they're going to be able to tell you if the deal is going to be able to get done or if it's not going to be able to get done. So they don't waste your time at all, and they can help you understand the different nuances throughout that process. Fantastic. The third piece of this is that the best terms. So here's the really cool part. A lot of people don't realize this, but whenever you are buying a practice or starting a practice up, most banks, if not, 90% of them out there, require that you have disability insurance as well as life insurance to cover the payments for that loan, as well as to cover the total value of those loans. This goes up and down quite a bit for different types of loan sizes, as well as different risk profiles for the person receiving the loans. But let's call it $600 a month for those insurance rates. Very, kind of middle of the line for you. $600 a month you have to pay in addition to the loan to be able to have those insurances funded, to be able to have that policy, to have that loan. Bank of America is getting rid of that completely. So you do not have to have that. If you think about that, that's $600 a month, that's $7,200 a year. Over 10 years, that's $72,000 you're going to save by going with Bank of America Practice Solutions. It's really no brainer. If you're going to have to get a loan, which you are going to have to do 100%, you may as well go with a company that has great interest rates, has great experience with the industry, and has the best terms out there in the market today. So if you're currently in the process of shopping loans, 100% give Bank of America Practice Solutions a try. And if you would mention that you came through the SYDP community, it would help out the podcast a lot and also allow us to give back to our very gracious sponsors. Again, this is an advertisement, a paid advertisement. If you go to them, I will, have more advertising revenue come to me. So if you enjoy the podcast, I would appreciate you helping out our sponsors. And if you are interested in that loan process, just text the word bank loan, one word, BANKLOAN, to 33444. Again, that's bank loan to 33444, and we will reach out to you. Hello, ambitious dentist. Today I have with us Mr. Travis Hornsby, the founder, creator of studentloanplanner.com, which is a great URL, great business name. And as everybody that is listening knows, we have an epidemic in the dental industry, and that is that the cost to get into dental school is rising, and that means that the cost of being a dentist is increasing as well. You hear horror stories of people getting out with just a GP with something like $400,000 or $500,000 in student loan debt. And that's if they're just talking about their dental license. If you're talking about getting out with, your undergrad masters or anything like that, or going on to a specialty to become an orthodontist or something similar, you can easily get up into the seven figures of student loan debt. And that amount of money that you're going to have to pay back over a period of time can be pretty soul-crushingly difficult. So Travis actually reached out to me and said, hey, how's it going? I'm someone who specializes in student loan debt. I saw what he had going on. I was like, I got to get this guy on the podcast so he can share his message, and really kind of, to be honest with you, this is almost a self-serving episode as well, because I don't know a whole lot about student loan debt because I just went out and got a CPA license. I didn't go get a dental license. So I have a ton of clients that have these issues. And we, as CPAs, are not trained on student loans. And so I decided to invite Travis on to talk to us about it. So Travis, thanks so much for coming on.
Thanks for having me, Jonathan.
So Travis, everybody I like to talk to, I like to kind of get an understanding of like student loan consultant. Like, how did that become a thing? How did you decide to become someone who helps people with student loans, and especially for professionals such as dentists and vets and things like that?
Sure. So I have to say that I married into it. So my then girlfriend at the time, getting more serious, she discussed that she had six figures of student loan debt. So I used to be a bond trader. I traded billions of dollars for one of the world's largest investment companies, Vanguard. So I was trading, all this debt, building all the kinds of complex spreadsheets, doing all kinds of programming to try to find, opportunities in the market to make money for shareholders, and so got real proficient in particularly like Excel modeling and doing all that. And then took some time off, wanted to travel the world for a bit, and then she got a job here in St. Louis, where I'm at now, and basically, I was helping her figure out what to do, and then I started helping out some of her friends because they all had debt too. Mm-hmm. And then some of our friends that we knew in Philadelphia where we met, they also had debt from various graduate programs and professional programs. And so I built this spreadsheet with the Excel skills that I picked up trading billions of dollars in bonds, with Wall Street. And and then basically crafted a way to analyze all of the different pathways that you can pay back your loans with, because there's a bunch of them. There's income-driven repayment, and there's like 4 or 5 different options within that. There's private refinancing. There's stuff like the graduated standard plans, all this stuff. So there was just so many different options. I thought somebody's got to come up with a calculator that actually shows the cost of payback given all the different variables that go into it, because there's a bunch of them. And there was nothing out there that did that. So I made that and I shared it online, just thinking, oh, cool, here's a useful resource. And then it got picked up by Business Insider and Yahoo and got viewed several 100,000 times. And then a whole bunch of people reached out saying, help me, I have all this student debt and I don't know what to do. And then that's how I got into it. That's how studentloanplanner.com was born. And so I started just writing articles on different things that I was finding through analyzing different kinds of student loan situations. And then, various people just kind of ended up reaching out over time, and it's built up from that. So I've advised about $82 million in loans in the first 8 months of business, and, hoping to advise a lot more to save a lot more.
Yeah, so 82 million, that's about 3 dentists, I think, right?
Yeah, it was 3 dentists and 1 orthodontist and 1 OMFS.
Yes, that's all it takes. So, again, I am pretty ignorant on the student loan process. So talk to me like a newborn baby. I get out of school, I got $400,000, let's say $500,000, even $1 million, if that's easier for us to be able to talk through, in debt. And I get out, and all I really know is I got to start paying this back. I get a letter in the mail every month saying this is how much I owe, and I'm getting out there, and I'm making I'm doing okay. I'm making 150 grand as a GP, maybe 150 to 200 grand in certain areas of the country, and maybe a little bit more if I'm a specialist. Like what does that world look like from the doctor's perspective, and what are their options?
Sure. So first off, let me talk about how somebody gets to that level of $400,000 to $500,000. So the cost of attendance, the actual tuition dollars you have to pay, don't begin to cover the entire cost of going to school. As sure. People know. And so if somebody's in school, what's the problem is that the government actually charges pretty steep origination fees, especially for really high cost schools. So if you're taking out Grad Plus, those things are 4.25% origination fee plus a 7 to 8% interest rate. So you're not paying any interest during school, and they're totally unsubsidized. So you accrue interest at that level for 4 years of dental school, and then that's how you get to the $400,000 to $500,000 in the first place. Now, some places are less than that. Some you might come out with $200,000 at Texas A&M, maybe $300,000 at University of Florida, or something along those lines. But the final debt number that you end up with, that determines your strategy. So it's all about debt to income ratios. So my goal is to have everybody pay off their debt in full, because I think being debt free psychologically is a great thing in terms of outside of your business debt or your mortgage, because those are tax deductible.
Sure.
But but in the case of student debt, that's my bias, but that's not always the best thing to do for the individual. And so let me give you 2 examples. So we'll say one doctor comes out with $500,000 in student loans, gets a job at Heartland Dental making $120,000. That doctor probably doesn't have a chance to pay that back unless they move to a rural place and become a practice owner, and buy $1 million practice and feel like they just bought it from a 65-year-old, and all these procedures are just waiting to be done because the old dentist wasn't doing them, and so he's going to turn a $1 million practice into a $1.5 million practice. So that kind of person, they really need to be going on a long-term loan forgiveness option, like pay or repay in particular, those 2 plans, Revised Pay-As-You-Earn and Pay-As-You-Earn. And picking the right one depends on a lot of different factors, and we can get into some of those if we like. But basically, you pick one of these plans, you pay 10% of your income for 20 to 25 years, and then at the end of that, you get your loans quote unquote forgiven. So what that actually means is you pay taxes on that. So you have to come up with income taxes for a big bonus in year 20 or 25. For maybe it's a $500,000 or $1 million at that point, so you pay like 40% of that. You got to come up with $200,000, $300,000, $400,000 in a lump sum payment to the IRS.
Gotcha.
This is a big ticking time bomb, and a lot of people are in this situation. And what I tell people, that the math works out to that be in their favor, they have to put away money every month to put away what they need to do for the tax liability. because you don't want to have somebody having to come up with $200,000, $300,000, $400,000 all at once and not have been preparing for it. So, realistically, I think probably they'll do some sort of bailout thing, and the loan forgiveness will be tax-free because the government will have to repossess everybody's homes, which they're not going to want to do.
Mm-hmm.
But I want to prepare people for the worst-case scenario. And so that person, let me talk for a moment just about what their debt to income looks like long-term. I mean, they're probably not making more than 200, 225. Maybe they're making 250 tops, like 10 years in. They're not making a ton of money. Like, that's not necessarily a great situation, but it's the best way to make the best of not a great situation, if that makes any sense. So, if you got a ton of debt, compared to actually just trying to repay the whole thing brute force, and sacrificing and living on rice and beans and all that, we can save you money, get you a lot of interest subsidies, maybe save you several thousand a year, setting you up with the right plan, and show you how to, save for retirement, get, some money back in your pocket for doing that because of the way the student loans are structured, all kinds of stuff. So that's like the help me, I'm drowning in debt, I have no chance of paying it back at all ever. That's that
Sure.
strategy. The other big strategy is, hey man, I just hate paying 7 or 6% interest or 5% interest. And, I've only had $200,000 in debt because maybe I had a little help from a spouse or parents in school, or maybe I'm an orthodontist that just made a lot of great decisions. I'm 5 years out. I'm making $400,000 net after debt service, and I have, $450 in student loans. So that's the other case is somebody who owes less than double their income. If you owe less than double your income, then you're not going to be getting any interest subsidies. The government programs aren't going to do you much good,
Mm-hmm.
Because long term you're going to pay the loans off in full. So all you'd accomplish by sticking with one of these income-based programs long term is just paying a whole heck of a lot of interest, Uncle Sam. So in that case, what I do is I take the best refinancing deals in the industry, anywhere, and I go to bat for you and find you the best interest rate. So the best one, at least, that I can find. And so what typically happens with the dentist is they see an ad on TV for somebody, or they see an ad on Facebook that says refinance student loans, and they say, oh, I want to do that, and they'll click the button, and then they'll just apply to that one place, and they'll just sign on the dotted line. Well, I mean, that doesn't make any sense at all. That'd be like buying a car and only going to one place and looking at one model.
Sure.
Yeah. But a lot of people do it. So so those are the two big situations. And sometimes people refinance when they probably shouldn't. I mean, like if you're coming out with a new grad with $400,000 or $500,000 in loans and you're only making $120,000 to $150,000, do not refinance your student loans. It's not the right thing to do. You need to do something like repay to get some interest subsidies for a couple of years and then maybe prepay aggressively on the loans and knock them down a bit, and maybe then refinance once your debt to income ratio is decent and you're not going to be putting a stranglehold around you getting into a practice opportunity. So that's the general overview. I know I went into maybe too much detail basically, but you got two dentists and you got, the person who owes a ton, feeling hopeless they're never going to be able to pay it back. That's going for the forgiveness strategy. And then you got the person that, makes a decent amount of money relative to their debt, 2-to-1 debt to income ratio or lower. That person needs to get into a good refinancing deal.
Okay. So the way it works is it's not a magic number, but it's a good guideline of it. If you're not 2-to-1 on your debt to what your salary is or your income is, then if you're at that 50% of whatever, your student loan versus your annual income, then that is kind of the breaking point of where you don't really want to potentially refinance privately. You'd want to go ahead and go with the interest subsidies. Yeah.
And I have to say, you have to think about your spouse too.
Sure.
So I talked to a lot of dentists where the guy will have maybe 100,000 student loans because maybe they did the military route, or maybe they had parental support, and so they're making 150, 200,000 a year, and maybe they have 100,000 student loans. Great problem to have, but then they fall for someone who's maybe she has 500,000 student loans and is a specialist and making 200 or something like that. So if you just looked at her in isolation, you would say, oh well, she should just use the forgiveness program. But the problem is you have to look at the unit as a couple. So that's why I do couples consulting too when both people have debt, because it interacts in a big way. So if the one partner is making a bunch of money and then the joint couple's debt to income ratio was below 2 to 1, then it probably makes refinancing the right decision in that case. So I see a lot of situations like that where the couple's joint debt to income ratio is such that paying it back is actually the smartest decision, just to go ahead and get out of debt. And the couples that I see that do the best with that are the ones that say, hey, this is our income and our debt, and not, oh, this is your income and your debt. Because the way the student loan rules end up working is that it's going to hit the other person who has less debt regardless. I mean, like I joke with people, if you file separately for taxes, you're going to pay a ton in tax penalties. If you file jointly, then it affects how much you have to repay. And then if you get divorced, then you're going to get some walking out of the courthouse. So it's going to hit you either way. So you might as well, tackle it as a team and deal with it together rather than kind of having, his and hers or whatever kind of approach. So the couples consults are interesting too, because just there's a lot going on. And like I said, my bias is to have people out of debt as soon as possible. But for a decent cost. I'm not going to tell somebody get out of debt if there's $200,000-$300,000 of savings that I'm projecting for going the forgiveness route.
Sure. And this is all really good information. And I'll be honest with you, even with my numbers background, it's pretty confusing because if you think about it, like you really have to kind of have a beat on what it is you're even going to be doing for the next 10, 15, 25 years in order to be able to correctly project, do I make that decision to refinance or not? For my listeners, you're if you're listening to this right now, you're probably of the mindset that you either want to be an owner of a dental practice or you are an owner of a dental practice. And for those people, typically they're going to be in that higher income bracket. They're, in the beginning, that being said, in the beginning, the first year or two, sometimes depending if you do a startup or if you acquire a practice, your income levels are actually fairly low. They're depending on what practice you acquire. You acquire a practice that's netting $1 million a year, you're going to be doing pretty good year one. If you do a startup practice in the right areas and have the right help, you could also do pretty well, but you're probably not going to be just, swimming in gold coins like Scrooge McDuck or anybody like that. So your income that comes on the 1040 is actually going to be fairly low for a lot of those people in the first couple of years. So, for those types of people, is it better for them to wait until they kind of get through that push? And again, guys, I guess I'm going to listen to the answer first before I say what the listeners should do.
Yeah, sure. Well, I mean, and that's basically what I help people figure out.
Okay.
I mean, if you're really wondering what to do, send me an email, travis@studentloanplanner.com, and I'll probably be able to tell you. And here's the thing: if you're uncertain about what path you want to go down, I build that into the analysis. So if you're thinking I might want to do refinancing one day, but I'm not sure, then I'm probably going to look at it and set you up with repay to get the maximum interest subsidies so that we can keep that total balance as small as possible, so that if the math ever does work out where you want to do the refinancing, you're refinancing a smaller amount and paying back a smaller amount. And if you're real sure that, hey, like I just had a consult not too long ago with a guy that wanted to stay in a big city, was comfortable being an associate or buying, an average practice, and just felt like he wasn't really ever going to make, more than mid to low 200-something thousand. And I think that that's very accurate. I don't think he does have any chance of making more than that, based off of where he wanted to practice. And so in that case, then, I'm going to say, well, it probably isn't really worth that much kind of hedging your bet, even as a practice owner, because you're not making enough relative to your total debt. But let me talk to that population, your population that's more probably higher than average incomes, I'm going to guess, probably slightly less than average debt, because for whatever reason, it just seems like people that are going that practice ownership route tend to be a little bit more open to paying down debt faster and
Sure.
making more money and to do that. I've just seen that just talking to a lot of dentists. That group needs to be really seriously doing refinancing, probably. I mean, probably in 75 to 80% of cases, if someone's a practice owner, they need to refinance, and they need to do it as soon as they can get a decent deal, and as soon as they can comfortably afford the monthly payments. So, I would prefer someone having, their lifestyle not crimped at all, but if they're having a quarter of their money go into their debt, if a lot of times I like to ask people, just how much money do you God, that you could just throw at debt if you wanted to every month and not have to feel super stressed about it. And if somebody tells me, well, I could probably do $3,000-4,000 a month. Okay, that automatically that sounds like a good refinancing candidate, because that's somebody who has flexibility in their cash flow, their monthly expenses are under control, they kind of know what they are. I mean, that's a huge thing, is just knowing how much you're spending and knowing where it's going, and knowing how much is free every month. And if somebody feels comfortable getting out of debt and doing the practice ownership route at the same time, or they're already in practice ownership and they agree that they'd rather target and get rid of that debt because it's going to save them money and get them more of a guaranteed type return. Because a lot of people tell me, oh, I'd rather keep my debt around and then I'm going to have investment opportunities. Well, that's true. And I'm a chartered financial analyst and I manage bond funds, so I know a few things about this. And the thing that's so attractive with student debt, once you're making a certain amount of income and you lose all the interest subsidies, like I mentioned, is that it's a guaranteed return to pay it down. So, if you're paying down a 7% loan and you're definitely saving the 7% in interest, it's not tax deductible interest, it's after tax interest. So that means if you were to go out and try to find a bond, to put in your retirement account, you got to earn 7% plus whatever you'd have to, plus the taxes or whatever to get it in your retirement account and pre-tax yield. So that's probably like a, 10, 11, 12% bond in your retirement account. Show me a place you're going to get a guaranteed rate like that.
Sure.
Even if it's a little bit more complicated than that, but if you think about the guaranteed aspect of the return, I mean, shoot, pretty much the only thing that's going to exceed that is if maybe you're buying multiple practices and taking an active, partnership interest in, a bunch of dental offices somewhere, and you're having a bunch of associates work for you and getting 25% of the total. I mean, that's with risk, some degree of risk and effort. So
a lot of hard work too.
Yeah. And hard work, yeah, you're busting your butt. I mean, it's not easy money. You're not sitting on the armchair making one call a year with that. I mean, and that's the thing is when you don't have any debt, when you're done with your debt, you have flexibility. Okay, you can if you want to bring in that $10,000 consultant that might take your business to the next level and double your production potentially one day. I mean, then you don't really think too much about it because, oh, well, I don't have any big fixed expenses I got to meet, right? And then another thing that I like to think about and talk to people about is, dental practice loan is probably 7 to 10 years in amortization. And, I don't suggest, prepaying that just because it's tax deductible. So I think it's decent to keep it around for the duration. But, if you just line up the amortizations with paying back your student loans and 7 to 10 years of the private refinancing deal, plus paying back your dental practice loan, then it's all about delayed gratification, right? What you're setting yourself up for is a balloon, awesome delayed gratification windfall, basically, because you come into, your your late 30s, early 40s after this period, and now you got no practice debt and you have no student debt. And so now, your net take from the practice is significantly higher, and all that money, that you were used to throwing at debt is now available to do other things with. So you can take that super nice vacation, drive the super nice car, and, save a bunch of money to be financially independent from dentistry, within 5-10 years after that. So it's certainly something that I'm passionate about, is just saving people money, because there's no worse place to spend money in my mind than on student loan interest, because it's just unnecessary
100%.
Money, and you get nothing for it. You don't get a gold star because you paid $20,000, $30,000, $40,000 more in student loan interest. And that's what I'm trying to eliminate, is get that money back in dentists' pockets.
And so and I know it's probably a wide range depending on multiple different factors, but whenever someone goes to potentially refinance, I mean, what are the possibilities as far as like an interest rate that they can get down to nowadays?
Yeah. So right now, the best, the lowest rate period, for a variable rate, is about 2.6% for a variable 5-year. And then for a fixed rate, probably the cheapest you'll see is something like 3.3%, give or take, 3.375, something like that. So fixed rates to me kind of feel maybe like a little bit better deals, just because of how they do the benchmarking to how they make the lending decisions. So I'm probably recommending a few more fixed rates than variables these days. But in general, I tell people, if you get an awesome variable deal, and you're able to pay the loan back in within like 3 years is typically what I tell people. If you're able to pay the loan back within 3 years, then the variable interest rate risk is not really that big of a deal. Because like if the interest rate rises, you can just prepay it and pay it off faster. And if it doesn't rise, then that's great. You just keep it around because it's like lower cost debt. But some people say, you know what, I prefer I got this 7% rate. If I lock in this 3-4% rate, then I'm saving a spread of 3% on $200,000. That's $6,000 a year. I don't want to get greedy. I'd rather just lock in the fixed rate and get the guaranteed savings, and that's fine. That's totally cool. That's for 5 years. So most people couldn't really afford the 5-year. Most likely, most people that are doing a refinancing are going for the 10-year, and then the 10-year is probably like probably about maybe a 4.5% for fixed rate. And so that's probably the very best that you'd see for 10, and then for 15, maybe like 5, maybe 5.25, give or take. That's probably the best for the fixed rates. So a lot of people that are listening, you're sitting there with 6.8%, 7.9, 7.65, 6.5. I mean, there's all kinds of interest rates with the federal loans, and for grad school, they're almost always above 6. So, most people, if you got that debt to income ratio I was talking about, of 2 to 1, or even if you're kind of close by, like maybe you're like 2.25 to 1, or maybe maybe you make like 150, but your debt's like 350 or 360. I mean, then you can possibly refinance if you're willing to be pretty sacrificial, and pay it down maybe aggressively in the first year or two. And you probably will still get a decent deal. But yeah, I mean that's pretty solid savings to cut a 6-something, 7-something rate down to a 4 or 5-something rate. And for most dentists, that's what they're going to get.
Yeah, it's a pretty big no-brainer in my mind for most docs, especially ones that want because as a business owner, like your biggest enemy is a guaranteed cash outlay. I mean, if the faster you can cut those things out, the faster you have more flexibility in everything that you do. That money going out every month, or that cloud hovering above your head is a danger to your business. It's a risk.
Yeah.
That if something goes bad in the economy or in the business or whatever, then that guaranteed cash outlay isn't going to go away. So very important to make sure that we have that taken care of. So very cool. So as far as other things, amount of money people are paying and things like that, what are some of the other kind of big issues right now in the student loan world, if you will?
Yeah, well, a lot of people might have seen that President Trump proposed this big overhaul of student loans, and and it's a big change. So he's talking about doing away with pay, repay, IBR, PSLF. That's the public service loan forgiveness. Basically doing away with all subsidized loans. Really taking it to every single type of federal involvement in the student loan space. And he wants to, he basically wants to consolidate all of it into, a new plan, for lack of a better word, we'll call it the Trump plan. And it makes a huge distinction between graduate and undergrad loans. So for grad school loans, your repayment period would be 30 years for 12.5% of your income with no interest subsidy, best I can figure based off of the proposal. And then for undergrad loans, it'd be 15 years, 12.5% of your income for forgiveness. So that's a massive difference in treatment between undergrad and grad loans. And tack on the fact that graduate school comes after undergrad, so it's like even farther into your life. These things could potentially be forgiven. And basically, what the good news is that the proposal grandfathers in anybody that took out loans before 2018. So that's basically probably almost everybody that's listening to your podcast. So the takeaway is, you expect any big changes with people that are already in these repayment plans, but for somebody that's entering dental school in fall 2018, so not this coming up fall class, but the one after that, I think that the whole field is going to be in for an extreme, shock, because I've run the numbers, and for the highest cost schools, the long-term cost of this proposal is about 60% higher on average. So you're raising the cost of dental school of an NYU, Tufts, Nova, Midwestern, AT, still those kind of places. You're raising that cost by about 60 to maybe even 70% higher by this repayment program. And this is not a sticker price that someone's going to see. It's a price that people are going to feel over the course of their entire careers because of the length of time and such. So, if you think about it, basically what it does is for a dentist, it adds on 12.5% to your tax rate. So if your effective tax rate is 35%, federal, state, local, FICA, everything, then tack on another 12.5%, and that's your new tax rate. And then at the end of that, you need to pay off a big lump sum in taxes because it's for taxable forgiveness, right? And so then you probably need to tack on a few extra percent for that. So pretty much like what this new proposal will do is it's basically the minimum 50% dentist tax bracket club if you're going to a school with more than an expected cost in today's dollars of like $400,000. So if your cost of attendance for dental school says over $400,000, know that 2018 and beyond, your cost for dental school is skyrocketing with this plan. So that's the biggest news in the student loan space right now is just all the hullabaloo around that. But regardless of what the Trump plan comes out to be, because Congress gets a say in it and gets to bat it around, that's it's going to be it's going to change. So we're still kind of figuring out what's going to happen. But I don't expect huge changes for the people that I'm advising right now. Another thing I'm pretty excited about is I'm trying to convince lenders to enter the dental school loan space earlier than they're doing now. So what I mean by that is once you've come out with loans, maybe you borrowed $200,000 over the course of your education, but because of accrued interest, origination fees, all this mess, now you're at $300,000 at graduation. Well, my goal is to kind of nip that in the bud and make it so that maybe instead of $300,000, maybe you can replace some of the worst kinds of federal loans and get it to like $250,000, and then that's a heck of a lot more manageable. Then you can refinance that and just pay it off. So for your in-state schools, especially for people that might have to deal with $300,000 to $350,000, $360,000, $370,000 in total loans, that kind of cost. I'm trying to get Grad Plus loans replaced with private loans that right now would have to be co-signed by parents. That's the downside. But instead of a 7% rate with a 4% origination fee, I'm trying to get 5 or 6% in school with a 0% origination fee is what I'm trying to do. So if anybody's in dental school or knows anybody in dental school, have them reach out to me, Travis at studentloanplanner.com, and I can see if I can try to connect them with some cheaper sources of debt while they're in school too. It's a lot going on. I mean, the truth of the matter is dentists aren't that big of a risk. I mean, if you look at all the people out there that a bank can lend to, I mean, dentists are probably one of the least riskiest ever. And it's just because there's always, it sticks to the ribs money. I mean, people have problems with their teeth. If you have severe pain, your mouth, you have to have an emergency procedure done. You're going to pay for it. You're going to get it done. If people, if their two front teeth fall out, a mom is going to go in and she's going to take care of herself and get that taken care of probably, So, I mean, in terms of the risk of dentists, the dentists are being vastly overcharged by the current student loan scheme, both by the schools that are charging, I think, frankly, too much for the education, and then they're also being charged too much by the government for the interest, so that by the time they come back to pay it all, it's accrued tens of thousands more than it should have. Sure. So I'm trying to help people from all directions, basically. And, I'm excited to be doing this instead of just, spinning pieces of paper on Wall Street all day. Because it feels like I'm actually having more of a direct impact in people's lives.
And you are. So talk us through what happens when somebody calls you up and says, "Hey, Travis, I don't know what I'm doing with my student loans." What is the process of you doing that consulting?
Yeah, sure. So, luckily, I've gotten pretty busy lately with the word kind of getting out, and so I'm probably going to increase my consult rate in the next few months. So, but for right now, in the next couple months, reach out and I just charge $199 for an individual and $299 for a couple that are both borrowers. So given that my average savings for a client over the 20, 30 year time frame where they'd be paying back debt is around 70 grand, I'm saving a huge multiple of that by getting a plan in place. So somebody calls me, sends me an email, usually is how it starts, or they find me on on Student Loan Planner, and they look for the contact form and submit their question. But they do that. I send them back these 2 steps. Fill out the consult information that I need. Takes 5-10 minutes. You just give me all the kind of info about yourself, your family, income, career growth, that kind of thing. I take all that and put it into my analysis. So I make you an analysis, and then you also use my scheduling tool to create a time to talk. And then actually, I guess there's no harm in just handing that out on the podcast. It's just calendly.com/student loan planner. You can look up basically a time and just schedule me to talk. And then, we got that time in the books. I got all the information I need with the consult form. I do the analysis, and then I send that over to you by email, and then we just make a plan. So it's basically good old fashioned, like you might talk to a financial advisor about something about money, or like getting the right disability plan in place so your family's protected. It's basically kind of like that, but we just have our discussion about the best way to save money on your loans, and then you can reach out to me via email for a couple months after with any kind of follow-up questions. So the goal is to completely demystify loans in a single hour, save you from having to become an expert on student loans yourself and wasting countless hours of valuable time you could have been doing dentistry finding this out for yourself, and then getting, if refinancing is the right thing to do, which is the only time I'm going to recommend it, then I got the best deals in the industry that you're going to get the best interest rates for, and probably save at least 0.5% over what you would get by just kind of looking at it yourself and just doing it on your own. So, that's how it works, kind of start to finish. Just getting everybody's info, analyzing it, and coming up with the best plan.
Very cool. So guys, if you want to bypass just an insane amount of studying, as well as all the pitfalls of trying to make the right decision on your own, have someone like our good friend here actually do this for you. It's a no-brainer for that low of a cost. Doing this on your own would be a lot like doing your taxes on your own. It's just not a good idea. So contact Travis, let him take a look at your situation, and save a bunch of money in the long run. So it's a great deal. And again, this is something that I don't even, this isn't even in my world, things that I know that I look at. So, I'm, 100% signing off, have someone that knows what they're doing, look at it for you. So Travis, thanks so much for coming on today. You already mentioned how to get a hold of you and things like that. So, very happy that you're on the show today. Very happy for you to give your time. Is there anything else that you'd like to say before we go?
Yeah, and I think that free calculator that I mentioned that got the several 100,000 views, is a bonus for today's listeners. I think we're going to be giving that away for free. Yep. We're going to discuss, I think, in the show notes how to do that. Is that right? That's right.
It's going to be, we'll have in the outro, we'll have the description of how to be able to get that bonus, and be able to look at it yourself and see for yourself how much you could save.
Yeah, and it's probably going to be thousands of dollars. So get the right people in front of you. Get a great CPA and coach. Get somebody that knows about student loans, somebody that knows about investing and such, and just take control of your life, because the liabilities and just the cost of dental education is so high. You can actually make the return on investment worth it, but you got to put in the work. Perfect.
Thanks so much for coming on, Travis. Again, it's studentloanplanner.com, guys. Travis Hornsby. I'm glad to have him as a friend of the podcast now. And so, Travis, all the best, and we'll talk to you again.
Yep. Thanks for having me.
A special thanks for Travis coming on the show today. Chances are good that you may need a hand with your student loan. So while many choose to worry about it later, as Travis shows, taking action now can save you a ton of time and headaches later down the road. So Travis obviously knows what he's doing, and he's helped hundreds of people pay down their debt. So as a bonus for today, he's offered his incredibly popular student loan debt calculator, which helps you get clear on how to pay off your student loan debt. So I spent some time playing around with it, and it's really, really good. So to get this bonus, simply text practice to 33444. Again, that's practice to 33444, or visit startyourdentalpractice.com/bonus if you're outside of the U.S. You'll also receive updates on the latest episodes of Start Your Dental Practice, helpful tips for owning and running a practice, and promotional opportunities direct to your inbox.
So that's it for today's episode, but that doesn't mean that the learning and implementation have to stop there. I've created a free report called The 15 Numbers That Will Make or Break Your Dental Practice. This report has been downloaded over 1,000 times by dental professionals. So if you want your free copy of this report that's going to outline what the most important numbers are in any dental practice, and it also includes how to look at your numbers, how to set goals, has a whole slew of really important information that is the culmination of all of my experience as a dental CPA, then just go to startyourdentalpractice.com/free gift. That is startyourdentalpractice.com/free gift. And so that's it for today, Ambitious Dentist. Again, I'm Jonathan Van Horn, CPA and ABV. I'll see you next week with another world-class practice owner or consultant that will help you start your very own dental practice. Thank you guys so much for being a part of the Start Your Dental Practice community. If you enjoyed today's episode, please do me a favor and go to startyourdentalpractice.com/iTunes to leave your honest feedback and review on iTunes. It's going to help me create a better experience, a better show, a better podcast for you, the ambitious dentist. Your feedback really does help, regardless if you like the show today or not. If you didn't like the show, let me know, because it's going to help me create a better show and podcast for you. Lastly, if you know of anybody that would benefit from today's episode and today's content, today's guest, please feel free to share with them on social media or through email.